Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Wednesday, February 18th, 2026. We're going to run it again. The last one, the audio was not recorded. Thank you. A couple of folks had brought that to my attention in the comments section. It is a function of the screen recording software. I haven't found better software out there. I believe this is the Premiere. It's called Camtasia Studio, and you can't see. They get a little float up toolbar when you record, and it just every now and then will randomly turn off, deselect the microphone, the Yeti Blue microphone I have record for the input for the recording, even though it shows the recording feature is turned on, shows audio. You have to go into the settings, and it just sometimes, and it's so random I don't check it each time, it just toggles it off. So sorry about that, guys, but I'll leave that video up. You can kind of skip through, eyeball the charts. When you see a YouTube video, you can either play it on YouTube or you click play on the site, and you can always do this. There's no audio, so you can move forward like this. This is what I'll do sometimes to reference, if I'm trying to look at something I covered, make sure everything came out right, and see the charts I'm covering. And a lot of times you can see where my little cursor's going and what I'm talking about, either way. And so I'll just start over. Should go a lot quicker since this is a second draft. So all right, so, and there's one update sent. So remember, I often will post additional things in the comment section, and I just got this one out there. So earlier today, in two different posts, let me just go back here on the site, both, the first one today and this one here, I posted this following charts I'll show you. Yeah, I gave you a bounce target range. We at the bottom of that range, and then at the time I told you I figured that's here, and this is the first one I gave you. NQ was approaching the bottom of that 25,090-ish resistance level, plus a downtrend line there, which increased the odds of a tradable pullback. That's it. So that's just going, and that's at least a target of 24,878. As I went through the video, let's see, I'm squishing the chart, and you're not seeing the whole thing. All right, there, I have to come down. All right, so that's that. And then I went on in the video and showed you, there's the target just got hit right as I am starting this video. And in that video, which there is no recording, again, you can look at the charts, I gave you my thoughts, all right, and I covered a lot of stuff in there. I should be able to do it a lot quicker since I already covered it. Remember, we're at, one of the things I said, we're a lot closer. The markets are, especially QQQ, is a lot more at risk, if you will, for lack of a better word, of breaking down below these trading ranges than it is breaking out. And so what I had kind of summarized in the video before, taken collectively, remember, I've highlighted that custom Hindenburg indicator that I created for the NASDAQ years ago, but I've been highlighting it recently because it's triggered more clusters than I can ever recall it triggering in short order, more sell signals. And so what I was saying is I think the risk of a crash, calling a crash in the market or anything is often a fool's errand. We did it on silver recently. Got that post out to you on a Thursday night. Said the risk of a crash looks like it's, could happen as early as tomorrow, Friday, which it was that Friday, or the following week. And we got that, and that was the biggest crash since 1980. Listen, it's not what I was saying in the other video. Okay, with silver, it might have been the only time in my life I ever called for a likelihood of a crash, because the conditions were there. The conditions I had been stating, it had moved, it had gone completely parabolic, and at that point it was indicative of a near-term buying climax, and more so we had a specific level, because as I said, it could have kept going up. When something's going parabolic, it keeps going up, and the gains at the end are just increasingly larger and larger. But we had very well-defined trend lines that I had a high degree of confidence would trigger a sell signal. And all it takes then at that point is a catalyst, because once you break that support, because the shorts have blown out, they've left the building in silver, that they had left the building at that point. I can't imagine many shorts are still holding on to a silver trade that, after it had gone parabolic the rate it did. And so therefore, those are very, 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 very rare and unique conditions. Now, we don't have, my confidence of a crash in the market isn't as high, but it's there right now. The probability, we'll see. We're all going to find out together if that custom Hindenburg indicator has any predictive value that's been triggering the crashes. But where I was going with this is, in the video, and I'm going to do it again, there are a lot of what I see risks that aren't being priced into the market. One of those is credit spreads. I didn't queue it up in that video, and I'm not going to do it now. You can pull that up. Google, credit spreads. There's the Bank of America, high yield index. There's others that I follow, and credit spreads are historically low. They're not pricing in much of any risk at all into the market. And for those who are not familiar with those are, that's the differential between what a investment grade, low to no risk U.S. Treasury bond is paying versus corporate junk bonds, right? And so normally you're going to get at all times you're going to get a premium. You're going to get paid more for a bond with the same maturity, a high yield bond, because you have a lot more risk. Those are the below investment grade credit bonds. They're still paying their interest, but their credit quality is a little iffy. And then during bear markets, corrections, recessions, credit spreads widen sharply. The markets will then price in the risk of defaults. So that's what credit yield. And it's one sign that I've used and many others. I didn't come up with it. Many professionals will look at that to monitor credit conditions, look for underlying cracks or risks in the market before they actually manifest in the form of a big drop in stock prices or a recession. So where I'm going with that is I do believe that is being underpriced, and here's where I'm going. That crashes in the stock market are extremely rare. I wouldn't, they called this a crash, back here. We nailed that thing down with impunity, and then covered the lows back in 2025 when Trump started talking, long before he stepped to the podium to talk about tariffs. We were already short, gamed it down. And then I predicted the closest thing to predicting a crash. I called it the lights out level, or the bottom would fall out. If we took out a support level, I highlighted that day, literally the day before he stepped up to the podium. Day he did step up. And that's what happened. Then that was the closest thing to a crash right there. The rest was a semi-orderly correction, right? All right, so I don't want to get hung up on that word, but it's just, if the ingredients right now are there. And part of that is you can't have a lot of people, you almost have to have hardly anybody expecting it or it doesn't happen. Why? Because if a lot of people are expecting and think the risk of a crash or a very quick swoon down is high, you get high short interest and you get a lot of put buying. So I do monitor things like the put to call ratios, short interest ratios, and because when you have a lot of puts, that's the protection that's going to come in and stop the slide. Protects those portfolios so they don't have to sell their longs, because they're institutions and individuals will hedge. They'll buy puts against the long positions they own, and then also high short interest. Institutions and traders like myself will short, and then you have a high short interest. And I always have said there's only one guaranteed buyer in the stock market, and those are short sellers. You may be a foaming at the mouth, raging bull on an asset. Let's say it's NVIDIA or silver, or you pick the stock du jour of the market. And however, one of two things: maybe you're already fully invested. You have all your capital in your portfolio committed. You don't have any more buying power. So in rhetoric, you're still bullish. In positioning, you're bullish, but you're not adding to that supply demand dynamic. You don't have any more capital to buy. Buying is what makes stocks go up. More buyers than sellers in any asset. That's economics 101. The asset will go up. The other thing is, you may be that foaming at the mouth bull, talking the talk and planning to buy dips and add more, and whether it goes up or down. But something may change your mind. You don't have to buy. You may change your mind and not end up buying. Whereas a short seller, when I or anybody shorts a stock, you must buy that stock to close out. You're borrowing a stock from your broker who's taking it out of somebody else's account, another customer's account. That's how short selling works. And they're loaning that stock to you, the stock that somebody is long and owns, and then you're shorting it, and you must close that transaction out at some point, hopefully for a profit. If not, you're going to get stopped out, and that's a buy to cover, and you're buying it and you're adding buying pressure. So that's why I say short sellers only. And so, those conditions are here. We have low short interest, excessive bullishness. We're coming off especially extreme bullishness and all that stuff. So either way, we'll see. And most importantly, again, we're in the video I measured it. I'm going to do it again. I think we're about we have to drop about 3% to take out the 589s and get down to the 200-day moving averages. Whereas on the upside, we have to go up about 5.5% just to test the new highs. So that's why I'm saying the risk right now, if there's a risk of a breakout, if you're if you're short or long, the risk is you have a greater risk that we break down because of just the direction there. We're not going to go up 5-6% in one day. You also have the midpoint line as resistance. So keep that in mind. And so let me go to the 60-minute chart. I already covered this is the same chart I gave you. That's the same trend line on NQ that I gave you where we hit and that stopped. So that was the objective reversal point for the pullback trade I gave you, and there it is so far. Nice reverse off that level. And so what I was saying also in the video, again, I'm trying to just recollect my thoughts how I did it. This is, we've been in a trading range, and you guys know my big part of my trading style is just look for these divergent highs and divergent lows, right? This is swing trading. Here, let me pull an NQ chart and I'll show you even better. This is a 60-minute chart NQ. I prefer futures in my active trading account. And I'm just circling all the divergent highs and divergent lows. DL, 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 DH. DH means divergent high. DL means divergent low. And so a divergent high, you had this trend here. And then all the way up to that, actually, there was a divergent high. And then after that divergent high, that was the technical catalyst that sent the market down. And then you put in a divergent low. And again, there were sell signals along the way, trend line breaks. You don't just go long or short just because something has positive divergence. You wait for that condition and then couple it with a buy or sell signal or multiple sell signals or buy signals. And then that's it. So you can see these are the typical swings, right? And so where I was going with this is I gave you a range today. It was colored in with the screen capture tool. I think it was, what was it? Where's my box tool? I can't remember if it was, got my box tool there. And we hit the bottom of the bounce range, and we also hit that downtrend line. If this is all we get, and I'm open to that, and I'm kind of leaning that way, that this bounce we had here off this divergent low, which was only in the futures about a 2.6% bounce, it would certainly be atypical if that's all we get and we go down and break the bottom of the range, and it would catch a lot of traders off guard because, again, you can just eyeball, if you want, you can measure the trends that you got, the tradable. These are just swing trader, the world of a swing trader. They were all larger than this, including this last one right here. And so if this happens, and this is all we get out of that divergent low, we go down, especially if this divergence is taken out. Because look, there's a lot of scenarios here, and that's why I do these videos. You need to mark them out, mark the charts up, kind of be just reactive. You could be proactive in your plan and what to look for and levels to, that you anticipate for a breakout or a breakdown to go long. So this wedge could certainly extend. We could come on down a little more. We could even hit the bottom. If we did that, we'd have another marginal move and still divergent low. I can extend my divergence lines and then break out. That's going to be bullet. That's one scenario, especially if it keeps us within the trading range. However, if we go on down through here and we start going down and we take out, we burn through this divergence, it's no longer there, that's going to be very bearish. So that's something to watch for. If that happens, then I think we'll take the bottom of the ranges out, 589 on QQQ. And remember on the daily chart, 589, the 200-day moving averages. SPY is much more in a better technical posture, but the level to watch there is about that 674 midpoint line. This is the big trading range. It's the same range QQQ entered back in early September. except SPY has spent most of the time on the upper half of the range between that delineation line right there, the midpoint line, about 674, give or take. And so that would, QQQ would break down first. Now, something for everybody here. So if you're looking for a catalyst to take the market to new highs, upside break of these ranges and followed by a nice tradable trend. Well, one possibility is that big tech, the Mag 8, start to take the baton back. And because we've seen, if nothing else, I started talking about it months ago, and everybody you turn on, any media outlet you read, financial media, TV, they're talking about sector rotation. And you can see it in the trade ideas on this site. We've been long, short, and most of those trades, not all, but most of those are firing on all cylinders. It's been a stock pickers market, one of the best stock pickers markets I've seen in a long time, where investors have gone, S&P 500 investors, or especially NASDAQ 100 investors, have gone absolutely nowhere for months now. And yet there's been a tremendous amount of money to be made in this market. You can't do it by sitting and holding an index fund. You have to be in and out of different sector funds, long and short, or individual stocks. That's where it's been. And so again, that may be the thing. Now, I talked a few weeks back about the condition known as terminal lucidity. That's where a terminal patient has that moment of brief lucidity and they connect with their loved ones. You have a great conversation, and boom, right after that they pass away. It's a medical phenomenon, well documented, and I think that's kind of what the market's doing here with this sector rotation. But we'll see, and I'm open to anything. And look, guys, the levels will dictate how I'm going to be positioned. So there's support right there on SPY. Bullish if it can hold it. If it breaks it, we're probably going to go to the bottom of the range, which is already what I suspect. Coming off this divergent high, and then the 200s are right there. You break that, that should be lights out for the stock market. Again, keep in mind that QQQ can do that because QQQ has to fall and just to come back. Look how long it's been since the SPY has tested the, if I said QQQ, I meant SPY. Look how long it's been since SPY has tested. The last time it lost the 200s here, back tested right there on the 200 simple, regained them with a huge gap up, perfect back test, and has not come and visited the 200s since then. That was back in May. So at minimum, even if you're bullish, I think you want to. If I was long-term bullish, I'd want to see that. I'd want to see that pullback there, and maybe we get it just because every now and then the S&P 500 or any index is going to come and it's going to check or visit its 200s, even in the strongest of bull trends. It's healthy, purges out the excesses, gets rid of a little excess of bullish sentiment, sucks in a few shorts, to give you the fuel because then they cover. So that's kind of I think for me, that's an optimistic scenario. If we just break out of the trading range now and keep going, the upside's limited because we're so overbought, so far away from the 200. So again, that would be a bullish scenario. Now, if we take, and it's not my scenario, but it's certainly one if I think it's going to happen at the time, I'll trade it. But this is lights out for S&P. So I just wanted to point out that QQQ is going to break down first below the trading range, and it's not necessarily, could be the catalyst that gets this market just buckling. But remember, it's going to take most likely if and when QQQ breaks 589 and cuts under the 200, it's going to hit this second target. We've had this one all the way from back here. We had multiple short entries. We hit my first target there, hit it again in the after-hours session a couple weeks ago. And so that would drop you down here, T2, at the same time the S&P 500 would be, even though there'll be all that talk of the Qs being below their 200s, the S&P most likely will have at the same time be visiting their 200s, give or take, guys, give or take. So again, that's something there. Okay, and how to position for that? Look, I wouldn't, like I said, my degree of confidence of the market's going to crash isn't very high. I just think it's higher now than it's been a long time. The odds are always extremely low. You got to go off that. First and foremost, stocks go up most of the time. The stock market's going up. And even when it's going down, most of the time, 99% it's not crashing, right? So But one way to make money quick and or position or hedge is the VIX. And I've been highlighting the VIX as walking up this uptrend line recently. I've been highlighting it for the last few weeks, highlighting that it pullbacks to that level or objective, and it's, say what you want about it, it's in a near-term uptrend, so the VIX has certainly woken up, and it's coming off this most recent divergent low. We were long off this divergent low. I'll give you the initial trade idea on September 12th. That was right about here. Then we broke out, and the VIX did the same thing. It walked up an uptrend line. It was waking up, perking up, but not yet ripping. Then just one day, it would have been a breakdown in the markets, a sell signal triggered, big move up, followed by a little bit of consolidation and another move up, and it was a quick 100%. So most of that was, again, we were steadily moving up in an uptrend, coming off a divergent low, positive divergence, just like now. And so and it is my preferred scenario, it has been, I haven't waffled on that I will break down below the trading ranges and Qs. And then if so, the VIX is probably going to explode. The only line I've added to this chart in ages is right here, 2319, because I wanted to capture these two most recent reaction highs. And so pretty much if you punch through those, and especially if it coincides with the breakdown of QQQ below the trading range or the 200 days just below it, you're probably going to rip up here. This would be your first stop, first target, and I wouldn't be surprised. Again, if we get a crash-like scenario, we can just explode. That's the nature of the VIX. We were long off this divergent low too. Had that initial, this had happened pretty quick there. There was a quick up. And then it, kept making, had a pullback, but it made higher lows over that low. And then it made another higher high, another higher low. That's all the makings of an uptrend. Then the big explosion right there, and that was in April. All right, so this is, again, I've been highlighting the attractiveness of the VIX. Those VIX tracking ETNs, you're going to decay. I personally like the futures, but if you don't, there's a bunch of them out there, VIXY, or I don't know, there's a whole slew of them. Oh, and what I said in that other video is I can't make recommendation. I can't give individual investment advice. I can tell you what I do, what I don't do, what I believe, what I think. And one thing is, I think it doesn't make sense to buy a leveraged VIX ETF. The VIX itself, even if you use the non-leveraged ETFs, VIXY, here we went long here. There was my second target off the low. I don't know exact entry point. It might not have been. It probably wasn't. It was close too. I think it was right off the low. 114% in a matter of just a few weeks there, right? This last time here, we went long there, and it was a quick. Oh no, I just moved my line. Didn't mean to do that. Quick 25%. All right, but where I'm going with that is, and I've said this before, using leverage, the VIX is so volatile in itself and moves so much, in a single day, it can easily go up 30, 40, 50% sometimes. And it can go up, here it was 30, and it did it again a few days later. My analogy is like going to the Porsche dealership, buying a 911 Turbo, spending $250,000 or whatever that car costs, and then going up the street to your mechanic and having him put nitrous oxide on it. It is complete overkill. You can't even, that car is faster than you can drive it in any, urban setting in the United States. And why put nitrous oxide on a twin turbo, Porsche 911? But, and that's, so again, the decay is going to eat at you. If you happen to have the best timing in the world and you can get in right there in a unidirectional move that has very few counter trend moves, are right there. And again, we were long in a lot of these, but it took a while. We grinded around. This is where the decay, especially in the VIX, will eat those ETFs and ETNs alive, meaning work against you, especially the leveraged ones. So that's just kind of that. Either use futures or the ETNs. And again, you don't need to put a lot. If you're targeting, the VIX off this divergent low, if it comes up, if we do break the trading ranges, I could easily see it running up here to that 60-14 level. It's 300-something% run. We're already, part of the way in there. But again, the VIX is just kind of grinding higher. So, all right, I don't want to spend much more time on that. I think I made that point. Let's see, XLF, as far as the market goes, remember the, Mag 8 continues in tech. lag. It has been the leader for not just the last year, it's been the leader for decades. So the leaders are sick right now, and that's typically indicative of a market top. You can play the glass half full kind of scenario and say it's just healthy rotation. We saw that's why the S&P in recent months did better than the NASDAQ 100, because when big tech was dropping, they were buying the financials, and financials took the market to new highs. It is the second largest sector of the S&P 500. There's virtually no representation in the NASDAQ 100, and that's why the difference in those two charts that you see right now. Then, S&P still closer to the new highs, all-time highs. But so I had a lot of check marks. I had a breakdown, back test, and a rejection, then a failure of breakout of the previous all-time highs right there. That was a check mark. Then a little bear flag, broke down, went down below this trend line, back tested, then took out my 5310 and the 200 days. That was an additional check mark for me. And we recently hit, this was the level. I had it colored yellow on purpose because that's my lights out level that I've been talking about for many months now, that I believe when that goes, then the market goes, because again of the importance of the financials and the weighting that they have in the S&P 500. So just to kind of where we're at today. So we hit that level. I would have been surprised if we went through it without at least initial reaction, because the last time we hit it was right here. And we did. We bounced. And look where we bounced back to. The 200 were kissed today at the highs, the 200-day simple moving average right there. And you have the 53-ish resistance just above. So if things go as I think they do, this bounce probably over or about to be over. And then when we break 51, the S&P 500 will most likely then drop below its midpoint range line right there of 674. Head down towards the bottom of the range, because that is what tends to happen once you get on across either side of that. Usually the next stop is the bottom, and when you get back above it, usually the next stop is the top. So that's how I see it playing out. But again, as I like to say, support is support until unless broken. You need to break that, and you need to break this on QQQ. Otherwise, if they hold those support levels and we start breaking, QQQ gets back up in the midpoint, then it's probably going to go to the top of the range, and then it may make a run at another new high. So those are your levels to watch. And again, this trading range is getting very, very long in the tooth. And this is what I favor, but you got to wait, to get aggressively short. You need to get the sell signals. So until then, this is the market we have, bouncing around like a ping pong tournament right in the middle of that range. A couple other charts I covered in that video this is the yield curve. Not hearing a lot about it lately. It has a historically, at least for decades, a perfect track record. Very few indicators do of predicting recessions. So this is the zero line. You have this is the 10 and 1 year spread between the 10 and 1 year treasury, and down below, let me roll it up here. Let me make it a little bit bigger. We have the 2 10-year. The had a little, it wasn't even a whipsaw. I don't know if you can see it in the video. Let me see if I can make this bigger for you. 1 second. Let me try to roll this. Oh, I have to remove that. Scroll. We can make it a little bit bigger. Let's get it that big. Let's center this. All right. Give me 1 minute. I probably should pause the video while I do this so get it centered for you, but that's what happens when you zoom too much. Kind of breaks the screen. All right, let me take it back down. Bear with me, guys. Here we go. Good enough. We'll look here. There's a 210. These shaded lines, hopefully you can see them. This one was so small. It was a sliver, but it was a recession. Keep in mind, recessions technically are declared by the NBER, the National Bureau of Economic Research. It's a U.S. agency or quasi-agency, whatever you call it. They declare them, and they declare them based on pretty much subjective criteria that they get a pick. So there's, the old school definition is 2 quarters of contracting GDP. We do have GDP coming up on Friday. It's been strong lately. But remember, GDP, especially GDP, is subject to big revisions. And the NBER always declares these recessions in hindsight after they started. And so what I'm getting at is we may could very well see, and I believe at one point in 2026, they'll come in and the line is going to get added, retroactively to where the recession begins. How big it is, that's yet to be seen. There was the last real recession. COVID was one, but it was, over before we knew it, short one. This is the dot-com bubble. You can see the years here, and hopefully you can see these shaded areas. Early 90s, 80s, we had a couple close together. 70s, it was known for right there, a couple recessions. And you can see the gaps have gotten larger. This is when the Fed figured out they can just keep printing money and try to prevent all future recessions. I think that's a very dangerous model. I've talked about it, kind of like those prescribed burns in the forest. If you let the undergrowth grow, you're going to create a much larger fire. Once lightning strikes or campfire starts fire, it's going to burn down all the 100-year trees and everything with it. And again, they were able to do it since the financial crisis. Come in each time the market and the economy even began to sniffle before it even got anything more than a cold. And when it got the flu and COVID hit, they hit the nuclear option. But as I've talked about, they've lost control of the long end of the yield curve, so the bond vigilantes are not letting them. Made it pretty clear, at least over the last couple of years, they're not going to be able to be as nilly-willy with printing money and going down to a zero rate policy as they were in the past. So we'll see what happens. Either way, guys, my point here I want to make is that it's not the yield curve inversion, as they even tell you in here. It's the uninversion when it crosses back over. And you can see there's always a lag time, and it's usually months to years. And so we did uninvert here recently. And, if the yield curve goes up like this, then I'll say it's the first time in decades or in history that didn't accurately predict a recession if we don't get one. But there is a lag time. And so I think, according to these charts, you can see it uninverted here. KISS there, the 210 never crossed inverted, but the 110 did. I just showed you above. So there's the uninversion. Here's where we're at. There's the uninversion. There came the recession. There was the inversion, uninversion. So that one I covered. And the other one I covered in the last video that didn't have audio was this one. I've covered this many, many times in the past. This is unemployment. I just had this one queued up. Some of these, you can find these charts. Go to the U.S. unemployment rate. This is going back to 1948 up to 2026. And basically, it's simple stuff, and I've covered this many times, that there's around 4% in recent years, up to about maybe 4.5%. This goes back to World War II back here. You're talking just to the left. That's the mid-40s. This is 1950. In modern history, this is about as low as unemployment gets. Or really, there's the trough line right there, a little lower, about 3-something, right? And then invariably a recession follows. And on the way down, you get these little squiggles, little rises in unemployment, but it keeps falling. It's a trend, and it's a trend that's almost an immutable force that once it clearly inflects, and again, you don't have to be an expert chart technician. When you can see more than just a little squiggle, that it's clearly turned each and every time in history. And again, you got to look for it when you get down to this range right here. This is the low end of the range. And this is where bulls that I listen to, the ones they march out on Bloomberg and CNBC, make the case as to why 2026 is still going to be a strong year, record low unemployment. And again, I'm given we are at the low end of the range, but the inflection point's already come. This is not a little squiggle. This is a clear turn, a clear V bottom. Now, COVID was a little, happened very fast. But so what happens is once the turn is clearly in, and you don't have to squint to see that it's troughed and now turned, then it begins to accelerate, and the recession has always come. Okay? So again, they're always V bottoms. Then you look for them at the low end of this, in the range. And so this makes the case. Guys, there's a first time for everything. Maybe the yield curve was wrong this time. That'll be a first. Maybe this clear V inversion We've seen unemployment, the rate steadily ticking up. It's still not concerning to Wall Street because it's in the low end of the range. But again, I look at trends and try to predict where things are going to go. And it would be extremely atypical to see after such a clear V bottom, clear turn, to see it drop down again or even remain low. And that's the projections that a lot of these economists and even the federal government are making, that we're going to just keep in this Goldilocks area. Show me when it happened. Show me when that, we stayed down there for anything. Even there, the turn was in, and that's probably late 60s, the closest. But we were still going lower, and then the turn came. But you can see they're almost always V bottom. So that's that one.